Good morning, welcome to the Market View for Monday the 30th of June 2014, and starting off with the British pound 30-minute chart from Friday, we can see that we had just one signal, and this wasn't actually filled, and the range for Friday actually looks very narrow indeed. From the high down to the low here, we have just 35 pips, which is incredibly quiet. So the low volatility that we're seeing across most of the markets is continuing at the moment with this sort of sideways movement of prices and very narrow trading ranges. There's not a lot we can do about it. So we are at the mercy of what the markets dictate, and at the moment they're dictating a narrow sideways trading range, and it's something that we just have to put up with because that's the way the markets are at the moment. It's irritating and very frustrating, but like I say, there's not a lot we can actually do about it at the moment. And even on the overnight market, you can see that prices are in a very narrow range indeed, probably around about 10 pips there. So not a lot to report there. On the daily chart, you can see Friday's activity there. You can see trading up to the 170 level once again, and then the market moving lower and then coming back once more. So let me just delete some of these fib lines. You can see there the market currently trading at, from the recent high to the recent low, trading at the top of the range there at 76% at 170.35. And just to recap, apologies there, I said 170 here, it's actually 170.50. This being the 170 line there. So the market's struggling at the 170 psychological level at the moment. You can see very narrow range on the overnight market as we look at this chart. Let's have a look, see what news we've got that will actually or possibly rev the market up and give some decent trades. And straight away we can see we've got nothing until 10 a.m. when we've got the Eurozone CPI flash estimate, which really won't do an awful lot, and then it's over to the US at 3 p.m. this afternoon for pending home sales. So barring any geopolitical events coming out onto the news wires, we could expect to see another quiet day, unfortunately, but there's nothing really to move the markets. But forewarned is forearmed, and that's the state of play at the moment. On the Dow front, we can see that the market, yet again, market opening, trading lower, only to be brought back and then trading lower again in the afternoon from the intraday chart that I have on my other screen, and then moving back to close on or near the highs for Friday. So let's just redraw these fib lines as well. We need to come off this high and this low now, and this takes us to the 62% at 16,884, and then the 76 at 16,916. So there are your potential upside targets should the market move higher on the pending home sales that are to be released at 3 p.m. this afternoon. On the implied volatility front, again, we dropped down sharply on Friday after Thursday when the market moved higher. You can see we still haven't breached the record low on the 20th of June yet, but the market there trading down to 8.63 on Friday. And notice the historical now, brand new low in the historical, which is, I'll just bring this up for you, and you will see that on Friday we also had a new low in the implied volatility, and I'll just move this up for the historical volatility, and a new all-time low in the historic. So there was a new low actually made in the index call, but we tend to follow the mean for the implied. But historical blue line, I'll just bring this back up for you, we see a record low there. If this goes to zero, I'm more than happy, because then we're going to have the mother of all corrections in this market. And I've no doubts about that at some point as we go forward. Whoops, sorry, that just knocked the down arrow on the computer keyboard. And yes, we are going to get a correction I have no doubts about that. And the lower this goes, then the bigger that correction is going to be. There's a lot of talk about bubbles, the disconnect from the fundamentals to the reality of what's really happening in the economy. We saw this with the GDP figures from the US last week, when the forecast came out far worse, the actual came out far worse than the forecast, and the market moved higher. So we know there's a total disconnect, and it's just a matter of time before this comes back. And as it always does, even though we've got the QE in the background, they'll reach a point where they can't print anymore, and the market is going to have to revert back to capitalism instead of this markets that are funded by the government. So you end up with this socialist market where there's government intervention. It's not a true capitalist marketplace where survival of the fittest should exist. The banks should have gone bust. They should not have been supported. No other industry would have been supported, and then the market would have had a clear out, and we wouldn't be in the situation we're in now. It would have had a natural clear out. But there you go. That's governments not wanting to see anything fail, or not allowing anything to fail anymore. So on that cheery note, there's not a lot else to report this morning, except to wish you a good day. Hopefully the weather will stay nice. As ever, thank you for your support. It's very much appreciated. And all things being equal, I will see you in tomorrow's Market View.